So the next session that we have now is Private Capital Redefining Economic Ownership. And it is my pleasure to invite Mr. Rajesh Sehgal, Director of the CFA Society India and Managing Partner of Equanimity Investments. Rajesh is a long-term investor with tremendous breadth and depth of experience managing early-stage investments, private equity, public equity for over 2 decades now. He has on-ground experience across emerging markets, countries, analyzing various industries and businesses spanning different stages of their life cycle. Rajesh has the distinction of being the founding chair of the Indian chapter of CRUF, a global body set up for learning about and responding to many accounting and regulatory changes that affect corporate reporting. He is a board member of the CFA Society India and of the Mumbai chapter of TII, the Indus Entrepreneur, a global non-profit community that works to help entrepreneurs in all the ways. He, as a deputy manager, corporate finance at SBI Capital Markets Limited in 1996, and swiftly moved to Treasury and Investment Group, where he was involved in investing in equity and fixed income securities. Rajesh, may I please welcome you on stage?
Thank you so much. So thanks for making it today on this Friday. I think you had a great session, a couple of sessions so far. More on the economic and the macro side, and then public markets. I think what we will share with you is a little bit on the other side of the pond, private markets, and to share her views, opinions, and have a discussion with us. We have Nithya today. I couldn't think of anybody better to share her perspective with us. She's been in the markets for over 25 years, started with Citibank, ICICI, etc., but has been with, for I think nearly since 2010. She's been with multiples, started investing in private markets, and I think nobody else has the breadth of experience investing in private companies. Some part of the conversation will also be touching upon the public and the private markets, pipes, etc. I think in addition to just being on the investing side, what Nithya brings is a lot of perspective in terms of having helped women investing more and more on the in markets, both public and private. She's she's not only a founding member of the India chapter of Bloomberg Women's Buy Side Network. So there is a network for all the women in here on the buy side. But she's also associated very closely with another body that encourages investing in private equity, that is WinPE. So without further ado, let me get Nithya on board here for a presentation that she's making. Please.
Thank you very much. First of all, thank you for inviting me to speak to this wonderful forum. I mean, I was sitting here since morning and I was thinking this is a room filled with very high IQ. Of course, I mean intelligence quotient, but also investment intelligence quotient. So, and I was almost feeling left out that मैंने CFA नहीं किया in some way, and I've been asking everybody कि CFA में क्या curriculum होता है, and I've been getting a lot of things on how refreshed it is, and and how contemporary it can be. So wonderful to be talking to you. I'll just set the context of multiples so that you get a sense of where I'm coming from in terms of presenting a few things. So multiples was started in 2010, and we've been over the last 13 years, we have put out about $2 billion. We've invested in 30 companies across sectors. Our popular sectors are financial services, which is about 1/3 of our portfolio. We have pharma healthcare, which is also 20-25% of our portfolio. And we have technology, which is enterprise technology, which is a large part of what we do, about 20% of our portfolio, and then consumer. So those are the kind of sectors, and we'll speak about a few new age ones as well. And we've been investing across from very young growth. So you'll find companies like Delivery, Dream11, companies like this, to very to late stage as well. So we would have invested in, at some point in time, in Cholamandalam Finance or larger companies. So it kind of spans and even control transactions. So just to give you a sense as how this part of the world is a bit different, I'll try to touch upon both private equity as well as the new upcoming private credit, which is I think where private equity was 10 years back, and see where both of these are going. I'm really looking forward to the conversation with Rajesh. So I'm just going to use these slides to set some context of the size and scale of the industry, how it has evolved over the last 10 years, and then we can probably have a good conversation post that. So the theme of today's conference is, shift in economic influence, how we have a new world order. And I think really what private equity has done in the last 10 years or so is redefine economic ownership in India. So I'm putting it in the context of how this has become a class which has become pretty large and dominant in this space. Just a few headlines pointing to how this has been developing. What really struck me was an E&Y report which I saw, which says that about 60% plus of FDI in India is probably now accounted for by private equity, which is a very large number. And that's, I hadn't put it into my head. When I started researching for this, it really struck me as to how dominant this had become. I saw the schedule for your sessions today. You're going to have a poster child of private equity later in the afternoon. Sanjay Agarwal is going to be here from AU Bank, and it took me back 10 years back. Like 2012 was when AU Finance, as it was known then, took a 50 million check of private equity in what was a DSA business. They were a simply direct selling agent for HDFC and wanted to become an NBFC, and they took a $50 million, which is nothing. And today you have AUSFB, which is 80,000 crores of deposits, 50,000 crores plus of market cap. That is the power. I think entirely driven by multiple rounds of investment, and of course, it's fantastic management, which has made that investment work to create this. So I couldn't think, when I saw the schedule, I said, this is the greatest example that we can have. I'll spend 15, 20 minutes just walking through some of the slides, which will set the context of the size, scale, and the scope of this capital, and then we can get into a conversation. Yeah, so just to, I looked back 10 years, where were we in 2013? It was a 9 billion, I've taken 3-year averages because we have had a incredible 2021 and then a little bit of a 2022 and 2023 thanks to COVID and all. So a 3-year average is a better representation of where we are. So from 9 billion to 48 billion annual investments of private equity into the country, it's a huge scale up. And many times we are asked to predict where this will go. And I would say, why not 150 billion by the end of this, this decade? Is where looking at the momentum and the opportunities in the country. We heard a lot about that in Dr. Subba Rao's presentation and Hiren's presentation as well. Even more importantly is the bottom half of this chart, which is exits. Because if we don't have this, we can't attract more capital into the country. And we are very pleased by the way that scaled up from 4 billion to about 25 billion per year. And this percentage, if you have almost an equal amount going in and coming out, it will be a great place to be. But we think at least we will get to 75%, coming in. 150 billion of annual inflows and 100 billion of exits will be a fantastic place to be. And just to kind of tell you, I had mentioned that we invested $2 billion over the last 13 years, and I was thinking back of our exits. We would have exited close to $1.5 billion in that same time period. Of course, we have to remember that every investment is a multiple of the valuation that we came in. So naturally, there's a bias, but just the absolute amount of investment and exits is it's an important thing. And why has this happened? This whole exits and how has this been powered is something we will look at. This is the about a lot of the exits, I would say 50-60% of the exits have come from public markets, which is great. But equally, 30%, 25 to 30% has come from secondary sales. And that's because of this ecosystem. Right from seed up to buyout, we have now a very interesting ecosystem which is developed, which allows private equity funds like us to pass on the baton of that investment to the next fund, which is there. So, things like I spoke about delivery, 100% of our exit in delivery happened to other private equity funds. Even in a company like PVR, which we were invested in, 40% of our exit happened when we sold it to Warburg Pincus. So it's important to have this ecosystem be there to create that exits. And give you a sense of the scale, I did speak about the 48 billion. A lot of it, 34 billion is still in the mid zone of where growth is, which is where India is playing as well. And 2 billion is a large number for early because the check sizes are smaller. And the buyout is something that will develop as we take this forward. Another very interesting number, if you go back the last 3 years and look at how much money has been raised from the IPO market, 65% of all the money raised from IPO market have been wide companies which were private equity invested. So again, for all the public market investors here, you will be seeing a lot more of private capital invested companies coming into the public markets. And if you see what is interesting about the names and the logos on this slide is the variety of industries that these are in. This is not just tech. So you do have some fintech and tech and enterprise tech, but equally you have consumer, equally you have pharma and insurance. So it's quite a wider set where this money is going. We did have a lot of noise around tech a couple of years back, but I do want to say that it's a very wide spectrum where the investments are kind of going in. Again, to put the scale in some perspective, we all celebrated mutual fund AUM hitting 50 trillion rupees. It was a very big moment just a few days back when the news came in. 50 trillion roughly translates to about $650 billion or so. So if you go back to my earlier slide of about $50 billion of private equity coming in every year, and over 5 years, let's say that's $200 billion. 200 into 2 will be roughly the AUM. Even if you assume that there is some appreciation in it, we are talking about a $350 to $400 billion kind of AUM in the country. So, and that's only growing higher. So again, to give it some context from how we see mutual funds versus the capital that's kind of going in. Let's take a quick look at private credit. Lesser known industry because it's still small and emerging. Where private equity was in 2013, private credit is today about $9 billion of capital coming in annually. Number of AIFs going up, lot of predictions, but I would say why not $60 billion plus by the turn of this decade. This industry is kind of developing even from, and you did see the ecosystem on private credit, on private equity, which was right from seed up to buyout. And we can see a similar development of ecosystem here from performing credit, which is companies which are profitable, which are able to service this debt, right up to special situations and distressed. And you can see the range of IRRs that people are playing in from 12% to 20% plus across this spectrum. So a very interesting space, a space I would watch very carefully, and many of the existing AMCs will kind of make a move into private credit as well, or are already making that move. I thought, having taken a look at the numbers and the size and scale of this industry, what are the different colors of this? Where is this capital going? How is it used? What are the use cases? And I thought to bring that alive, we can talk through some case studies. I've chosen most of them from my portfolio. It's just easier to speak, and you have the context and the numbers. But I would say the interesting thing is moving from growth capital, we are now seeing private equity used for carve-outs. We have non-core businesses being sold and then being 100% bought out by private equity. Shareholder realignment, Two shareholders started up a business, don't see eye to eye, private equity can come and buy them out. So that, or special situations which require shareholder realignment. Platforms, these are businesses entirely set up by private equity themselves and being held for long periods of time as they scale up. And finally, newer industries being powered by private equity. So I'll walk through some examples. We have two in our portfolio in terms of growth capital, which I can speak about. One is an earlier stage organic expansion, which is delivery. And you can see they have taken probably a 15x growth in revenue during this period, just our holding period, which was from 15 to 2021, right? So that is the kind of scale up that can happen. And this is starting as an e-commerce logistics company to become a fully developed logistics player and covering the entire country. So all of this, and they would have had several rounds during this period of money coming in to power this growth. On the side of this is a much more well-known story to the public markets, which is PVR, which has been a growth driven by inorganic expansion. We invested in 2012 to acquire Cinemax. So the number 3 player acquired the number 4 player and became the number 1 player. That was our thesis, to say that this is a great brand and we can build a number 1 player in the country. But it didn't stop there. In 2015, we invested again for them to acquire DT Cinemas. They have then gone on to acquire SPI through their own internal capital and then merged with Inox. So it's a dream story. When we invested, it was probably 150 screens to 1,500 plus screens now, and a 10x growth in revenue. So what is the role that private equity played here? They could have well gone out and raised this money in the public markets as well. I think two things. When you're dealing with such huge scale up, a 750 crore market cap company making a 550 crore acquisition, you do want a very strong financial partner with you who is also underwriting that. It does give the founder a lot of confidence to have a equally invested mind who is also evaluating that acquisition, because it's a very big leap. That is what PVR was, a 750 crore market cap company when we came in. Second is the trusted partnership, which allows the founder to dilute. At one point in time, we owned 21% of the stock in PVR, and founder was 25. That's the kind of extent of ownership. And to have that, to run a company with 25% ownership, and today it's even lower, with that, has allowed the Bijlis to take that call to say, I can be diluted, but I have a stable, steady partner around who will kind of work with me and kind of protect this franchise and protect our ownership. I think that's the role that we played there, even in this whole growth story. Couple of examples on the other use cases. In 2021, Multiples bought out the animal health business of Zydus Cadila. And it's very interesting to see the FY20 numbers of Zydus Cadila. You can see there's a little blurb on the top, which is 520 crores, which is the animal health business, which was very small in their scheme of things and probably non-core for them. And having bought that out, that is how the business has scaled up. It's got a life of its own now under new ownership. It was a 100% purchase by a consortium of private equity led by us, but the management has been incentivized, ESOPs have been created, acquisitions are being pursued, exports are being generated, all of which for a very well-run business, but which is non-core in a large group, wouldn't have been possible. So this is a win-win in saying A plus B can be, the C can be larger than A plus B, because it's now come out and has got its own, steam. The bottom half of this slide talks about our investment in IEX, where we had to do a shareholder realignment. A lot of you would be familiar with Indian Energy Exchange. It's been a listed company for a while now, but this is the history prior to it being listed. When FTIL was asked to step back from the ownership of this company, and we had already invested in the company, so we put together a consortium to buy out the balance stake. In this whole thing. So this was a shareholder realignment to say it's becoming from a promoter-led company to a much more widely owned. First, concentrated private equity owned, and then much more widely owned. But what did we do in this unforeseen shock that the company was going through was kind of held it together in terms of brought in a stellar board, changed the management, brought out the technology which was still sitting with FTIL to make this a fully secured company, and then took it to IPO. So those are the kind of roles sitting as private capital that we can play to, and to make this company resilient, and we undertook a successful IPO. It continues to do well post that. So it's really transformed into that board run company that from a different avatar that IEX was in. Different example where this is an incubation starting from zero in FY16. We had a thesis that affordable housing finance would be a very long-term growth sector. This is housing finance to the, you have a lot of companies that are listed now, Aavas and Aptus and so on, but it was a sector which was still young in 2016. And instead of going and investing in a company, we incubated a company, brought in management, 100% owners of the company at some point in time, 10% with management, 90% with multiples, and then have grown it. And just like the AU SFB story, which I mentioned, this is now going to be a 8,000 crore plus AUM company with under our ownership, and we have brought in other private equity now to take this journey forward. Eventually, Vastu will get listed. It will come into the listed markets. But this is a journey of really incubating it, bringing in management, deciding strategy, very deep work. I think through all these examples, I also want to bring out the fact that there is, of course, sector selection, investment selection, in which I think we'll have a lot in common with the public markets. But what happens post the investment is where the paths will differ, because there's a very active involvement in the portfolio companies, and kind of driving that whole strategy and talent acquisition and so on, which creates the alpha in this case. Finally, a little bit of example of how in recent times the entire EV sector, the electric vehicle sector, is being powered through private equity. We've had the OEMs, both old and new. So you've seen people like Tata's also bring in private equity into their EV venture, Tata's and Mahindra's. We have seen newer companies, Ather and Ola, which are not OEMs in the traditional way, but have taken private equity and set this industry up. We have seen all the enablers into this, whether these are battery companies, these are networks which are being set up, or battery recycling companies. So this is an entire new industry which I think is being powered by PVC money, which is very interesting to see. And we'll see more of this, as you need really long-term capital. The reason why this is possible is just the long-term nature of the capital, ability to stay with it for 6, 7, 10 years, which allows these industries to be created. Shifting the lens to private credit, where it is evolving is in terms of where, first is they go where banks cannot go because of regulations, in terms of either you can't fund acquisition financing due to the regulatory restrictions, so you can go in and play a role there, or where there's a requirement for flexible solutions. I can't pay back the principal for a longer period of time, so you need a bullet or you need a step-up kind of structure. We are also seeing a lot of venture debt, kind of private credit propositions which have become very popular. Allows you to push back the equity dilution or grow the company without equity dilution, so acts like a bridge. A lot of revenue-based financing, no assets to give us security. So can I not have just revenue-based financing? And funds for turnaround. And this is, use cases is going to develop. As I said, private credit is just taking off at this stage. So with this context, I think we can, probably Rajesh, we can move on to a conversation and talk a little bit more. This is more to set the context of the size and scale and the use cases. But probably we can delve a little bit more. You have tremendous experience as well on the VC side, so would love to get into a conversation.
Please. Fabulous. So thanks a lot for sharing your thoughts, and I think the examples really made the message come alive. In fact, I was sitting there and I was listening to all these examples and I'm saying, oh my God, private markets are that big and that meaningful. So let me start there with you and straight away go to a question where I think all of us can get some guidance and help. Predominantly India has been thought of as a public market country, right? A public market. Foreign investors, domestic investors, we all understand equities. But when we say equities, it's largely always public equities. Now, you come from a very different world, which is private markets, private equity. What would be a message or some insight that you can share with us, who are all, largely professionals here? You mentioned IQ in the beginning of the conversation. How do we travel that path if we are starting our career or, just about 5-7 years of experience? How do we traverse onto the private side? So from a very career opportunity side of things.
Yeah, good start, Rajesh. And, I would say that the first thing which I have really appreciated, and I actually come from the debt world. The first 13 years of my career was which started with ICICI and others. So I started with the debt world and came into the equity world. The one big thing which I have learned in this journey is it's a lot more than numbers. So in fact, I would say it's a little bit of mix on the private side, on even psychology for that matter, because half the time we are, judging managements. And while even on the public market side, there's a lot of reliance placed on management, but just given the size of the companies we invest in and the stage at which private equity comes in, there's a lot more depending on a few people as we enter the company. And when we exit the company, we feel that should be a much more wider management, but when we enter, that is the risk that we take. So I would say that the skill set is wider. It, of course, requires an understanding of real business and not just an investment analysis. That's the first point I would make. So as I see it, a combination of an MBA or a CFA or a CA and a CFA, I have found works much better because it is a lot more understanding of financial books as well. So we have a lot of colleagues which are, we have some colleagues which are CA, CFA and MBA also in the firm, but maybe too many degrees at that point in time. But I would say that a combination would be much greater, a better way, and a little bit of, and I have interviewed people who come only from the research analyst world. So where do we recruit from? A lot of our recruitments come from investment banking, come from other private equity or other funds, right? Other funds are a much smaller portion because there are too many funds to recruit from anyway. So investment banking and consulting. And why investment banking and consulting? Investment banking mein transaction karna aata hai. You've analyzed, you know how to undertake the transaction, you've interacted with larger companies. It brings a lot of, and you've also probably taken deals to private markets, so you can hit the ground running on all of these. Consulting is a good understanding of business, actually how it's operating on the ground. So I would say from a path to private equity, it would probably, one is the degrees and the other is where is the career path. It typically is coming from investment banking or consulting as it hits private equity.
Thanks. I think I'm reminded of my days with Templeton, where I would do public and private markets. And we would always have challenges in figuring out how to distinguish the recruitment or the hiring process between the two parts. And I agree to your point that private markets, you really need someone who's a banker, so is able to close transactions. Someone who's also a consultant who can actually, after the transaction closes, can add value. Yeah. As it's always said on the private side, your work really starts after you invest in a company. On the public side, it's very different. So I think that is the nuance there. But I think that said, private equity and private markets, some of the numbers that you showed up there is pretty sizable now in India, and it's getting larger. And I hope we reach your numbers that you had there by the end of 2030. But that begs a question. As Indian investors become more savvy, as family offices, fund of funds, larger funds, government entities now look to participate in the private markets, allocate assets to private markets. What in your opinion are the things that they should keep in mind when they're allocating capital on the private side? What would you advise them?
Yeah. So this is this is a question which, a lot of family offices throw at us. It's this whole family office as an investor into private equity has really grown substantially.
Yes.
I mean, when we started life in 2010, the first fund had 70 crores out of a $400 million fund coming from family offices. Our fourth fund, which we are currently raising or very close to having raised 800 out of $800 million, 2,000 crores has come from family offices. So that just tells you the scale of where things are moved. So what was traditionally seen as it is, an illiquid asset class, thereby higher risk. I always debate this higher risk bit of it, but let's leave it at higher risk for now. And hence, how do you allocate? Higher risk coming from illiquidity, higher risk coming from concentration. We all run portfolios which are probably 10, 11, 12 assets in each fund. So it is quite concentrated. So what started off as saying 10 to 15% of my portfolio should probably go into this illiquid asset class. And within those, maybe I should have 2-3 managers. Is how things started. To now, I think that number has moved closer to, just anecdotally, nobody is tracking this, probably go closer to 25%. As the number of managers have grown up, as the number of flavors have increased, right? Ek VC fund, ek PE fund, ek private credit, ek kuch aur, and it all has gotten added up. So I would put it as, and I've seen people taking, different views as institutions. See, first, one thing to keep in mind is think of this more like a small cap fund. You have many large cap funds which operate very close to the average. So the range between performance is much narrower. In private equity, the range can be very wide. So I keep, and we have several banks who have invested with us. So I remember one bank coming and telling us that, Madam, 21 fund में invest किया, 2 ही fund अच्छा कर रहा है. So the first point is there's no point investing in 21 funds. That is the point, because there's no average of this industry. The average is actually pretty low. So the thought really is to pick out, what are, full cycle fund managers, people who have some track record. You're able to see, that history, and then if you're anyway going to allocate a smaller proportion of your portfolio, stick to those funds who have really shown it on the ground. The global institutions, their philosophy has been to pick out fund managers, but then narrow them down with time. But not all of us are large institutions who can put in lots of money. There, it's better to go with a strategy. And I think just from a metrics perspective, people speak a lot about MOC and IRR. Multiple on capital and IRR is well known. But I would say an even more important metric is DPI. What is the distribution to pay in ratio, which is cash on cash, kitna wapas kiya. That is, I think, is important, because a lot of MOC can be a paper MOC, and you will not see the money for a longer period of time. So just looking at some of these metrics, as well as thinking of, so one is from the metrics, the other is how institutional is the fund, is how I would, I would put it, in saying that you could start off as a small 3-4 member team, but if you're scaling up, are you, do you have a team size which is large enough? Are your practices, in terms of valuation of the investments, in terms of reporting, how institutional they are? I think these are some of the questions as this asset class becomes more widely invested that people do need to ask. And there's a lot of variation amongst, you can show a very good MOC, but and it's difficult to value unlisted assets. It is tougher to value them. So there can be a lot of variation in that. So understanding what are the practices set up in the firm, and it's always good to tell family offices to say that if there are larger global institutions sitting in the firm, likely that the practices are institutional. Sometimes it's just difficult to evaluate by themselves. So look for proxies for that.
Absolutely, fantastic. I think, some of your slides made it very clear that the Indian ecosystem is now coming into its own. You have quite a few number of domestic private equity and VC fund managers, and consequently there's a lot of interest among LPs, not just retail, family offices, HNIs, but also institutions. So I think what you said, I think that education cycle has to go on. But let's switch gear now to look at, for people from the public markets, all of us, who are looking at companies which are coming into our public markets from the private side. And you had a good slide with some examples of companies who have recently gone in the last couple of years listed on the public markets. How do public market investors, think of private investors who are large investors in companies that are now listed? Does it muddle our understanding? Are there some things we should be wary about? That's one part of the question. The second part is, again, this prevalence of pipes. So investing in public markets, but with a very private equity mindset. What are your thoughts on that developing within India as an ecosystem?
I'll take the second one first, and we'll go to the first one. So, pipes, actually, it's probably the context from which we come from. We found it challenging. Because, this public market ecosystem is very nimble. You need to have the ability in public markets to go in, come out, which a capital like us is forever disadvantaged. We are the long only. We invest once, we exit at the end, and we have to give back our money. So just the context from which we come makes it extremely challenging. Second, and we used to do public investments, incidentally, in our portfolio. In our first two funds, we had about 25% of our funds was in public companies. So we did pipes, and we have actually raised the bar to say we will do pipes, but only in very special circumstances. And I'll speak why. This was one of the challenges of not being able to move in and move out of the market. Second is our positions are large. Our positions being large, one is, of course, ability to get out. That is changing because now this year has been the year of pipes. Incidentally, a lot of private equity exits have happened quite smoothly, very large ones as well. Coforge, Sona Comstar, CAMS, huge deals where private equity has exited very successfully to public markets. But the fact that when we sell, it becomes a statement. So there is a statement about, Blackstone ne becha, multiples ne becha. So it might actually, it can move the stock, it can, put paid to the rest of what you will be holding in the company. So that's another challenge. I think the third, from a pipes perspective, is primary investment goes into the company. Companies come and raise money when everything is well and valuations are high. And that's when they want to dilute their equity. So again, and why should you get, and information is available to all in that sense. So where is that alpha going to get generated from is another challenge we find. And finally, our LPs give us fees and carry to do some work, post-investment as well, and to have rights in the company, both of which are not possible when you're doing pipe investment. So just the context of where we come from has made pipes tougher. I'm sure there will be AIFs which only work on long only, public investing, but they're born for that. So that makes life simpler. But I think this mixing of private equity and public has made it tougher. Having said that, one of our most successful investments is PVR, which was a public company even as we invested. So what are the situations in which these work for us, very well for us, is where, there's ambiguity in the outcome and the public markets can't take that call. And we are able to take that call and that leap, right? Nobody could have said PVR will become number one, they will keep this acquisition journey going. And we are for us to take that extra risk, that uncertainty, that ambiguity. So consolidation stories work well. If you're able to get in, take a controlling stake, delist the company, works well. So some of those situations will continue to work well from a pipes. Coming to your first question on how should the public market understand a private equity owned company, I would say on the positive side, you should be able to look at the management and say, this is a good team. Ideally, a good private equity should have ensured a stronger team at the top with aligned incentives. So that's one big difference that you're likely to find. Good governance practices, largely, in all private equity invested companies. We do require a lot of MIS. We do require, in many of the companies, we have gone in and created the board structures in terms of all the committees, making sure there are independent auditor, kind of reviews of the company, bringing in good independent directors. All of that should be good. The big issue, two big issues to think about. Is the company ready to be a public listed company? Or is it, there is a bull market on, private equity wants to exit, they have brought the company a little bit earlier, prematurely into the market. And the reason I say this is, when we are invested in the companies, there is a lot of role that our teams play in how the companies are kind of working their strategy, working their financial control, and so on. And when we are ready to exit, that journey needs to be done to wean the company off this intervention. So is that weaning complete is one question that we need to answer. And the second is, which most public market investors worry about, is the overhang on the stock. Yes. Because there is a very large private equity investment sitting there. So some of that concerns have come off simply because of the large AUM in the public markets now and ability to absorb larger blocks, but it will still remain. If we indeed brought in a company which is 60% owned, by private equity, all of whom had invested 5 years back, there is probably going to be an overhang on the stock. So I would say a balance of good and not so good.
Yeah, I think as public markets grow and private markets keep pace, things will become easier as well. I think I don't want you to get too technical with this, but from an investment process point of view, right? And I've traversed both public and private, but I wanted your thoughts on when we look at evaluating a company on the private side, how is your investment process different than what we would typically do on the public side?
Yeah. No, happy to address that. I was recently, just like Spotify does playlists, at the end of their playlist, a lot of you would have got it. I was looking back at multiples playlist just to see kya kiya pure saal mein. So our funnel had about 232 companies come into the top of the funnel in terms of potential investment opportunities. From there, about 55 of them went into deeper work in terms of management meetings, actually digging our heels in and finding out more. From there, about 9 term sheets were generated. And from there, 2 deals were done. So just gives you a sense of how sharply the funnel is kind of filtered out. I'm sure you would have a similar experience, Rajesh, from there. But these numbers were fresh in our mind, having done them at the end of the year. So how are we, and also just to tell you the kind of companies we invest in, क्या होता है इनका market cap will be 2,000 to 4,000 crores kind of valuation of these companies, and at बहुत खींचा तो 5-6 हज़ार होगा. So it's in the 2,000 to 5,000 crores. So these are younger, smaller companies that we are investing in. I would say the big difference is just the level of diligence that happens. I was listening to Dr. Subbarao in the morning. He advised all of us that research report bhi padho, but go into the hinterland of India, and that's what we try to do in that diligence process in terms of extensive branch visits, meeting other companies, talking to employees of the peers, talking to employees who have quit the company. And you get to know a lot if you talk to employees who have quit the company as well. So a lot of diligence is one big differentiator. I think the second is a lot more work on understanding the management. So here, at least in multiples, we run kind of a model which not back-tested or anything. It's just a heuristic model that we are running at this stage, which is, we call it as LEL. This actually is, it's leadership energy level. It's got 20 factors which are actually characteristics of management. So for example, strategic agility, customer mindset, things like this. And this model gives us the red, green, yellow of what we think of this particular key person or key persons who are running the company, and then taking the call. So I think a lot more deeper work on the team and the management, and do we believe that the journey from this 2,000 crore valuation to 10,000 crore valuation, can this person or set of persons succeed, and what are the gaps? Third thing I would say big differences is we back ourselves to fill in some of the gaps. So it's not a as-is where is buying that we are getting into. Even if there are gaps, and more often than not there are gaps, we say once we go in, we can fill the gaps. So that is also goes into our, and that's how the alpha is generated. It's otherwise, private market valuations are very correlated to public market valuations. So there is no cheap deal. There is absolutely no advantage for being illiquid or anything. At some point in time in 2021, they were even higher than public market valuations. So we always tell ourselves there's no cheap deal, but really the risks that we take and the ability to back it up with our own team and advisors to fill those gaps and take it up. These are some of the big differences I would say.
Absolutely, I completely agree with that. And I was just thinking of a maturity curve of a business. In the listed markets, we deal with largely mature companies. In your private markets, companies are not as mature. Most of them are not as mature as the public market companies, but there's a certain level of maturity. My world today is early stage companies.
Actually, having said that, I have a question for you, actually,
All right.
if I may. We've all seen the peak of 2021 and the subsequent, we call it the winter, since it's been thoda bhi, sun nikal raha hai, but the winter
Funding
is...
winter, yeah.
So it's still there. And we sit on some of the younger companies as well. But I'd like to get your perspective. What is this version 2 of venture companies that are really coming up, and how are they dealing with that, and what are we likely to see in this after the winter goes?
Oh, I don't know when the winter is going, first of all. See, I'm still wearing a jacket. No, I think the funding winter was real. It's still real. Numbers that we saw coming out in 21, late part of 21, early part of 22 is when things changed. It's for investors like us who are at an early stage, again, the business life cycle curve. For us, it's important to have you guys flushed with liquidity, because our companies will exit largely to your stage. And then for you, it's very important to have a very vibrant listed market, because that's largely where your exits will be. So I think what the early stage ecosystem is today grappling with is the bigger checks, the larger checks. Last year, 23, the whole year, do you know how many $100 million deals happened in our ecosystem? 1. Right? That number was, it touched 50 once upon a time. That's 21, then 20, and then 1. 24, everybody, somebody said in the morning at the beginning, Hiren said, you start with a 15% growth expectation. End of the year, you say 0%. Next year, you again reset at 15% expectation, all of that. But India is changing. So our view is that 24 is not going to be an easy market as well. We are working very closely with our companies, like you work with your companies, to make sure that whatever capital they have, and at our stage of investment, capital is very scarce. Dr. Subbarao in the morning said India is a poor country. It's true. So our stage, taking that from our stage of companies are really poor in terms of liquidity and capital access. So if we are all in capital conservation mode, when this winter ends, nobody has a call on that. My question has always been, and again, happy to hear your thoughts on this. Let me throw a question back at you. When do we see this, or where, first of all, do we see these 100 million plus checks coming into VC-able PE companies, going forward? There was SoftBank, it's gone very soft. There was Tiger's caged. There are very few names, right? The guys who are really giving 100, 200, 500 million checks as if there was no tomorrow. Where's the check coming from?
So I think the real problem is companies were overvalued in 2021, and I'm just putting it on the table. And now people say they have to grow into their valuations. So and it's become a barrier, because existing investors and managements don't want to write down the valuations. It's an issue. It's because there are triggering clauses in the agreement. Everybody will have clauses which say valuation kam hua, to the dilution will not just be for that round. It will be the previous rounds also. There will be anti-dilutions which kick in from the previous round. So it can really erode, let's say the founder pretty significantly, and maybe even some of the previous round investors. So it's really stuck. So you would have probably seen the newer VC investments are still coming back. The VC investments done in 2020 and 2021 are a little bit in a stuck mode. The companies which wisely at that time raised 3 years of burn worth of capital and so on are still okay. They are just growing into their valuation and they'll probably do a flat round and move on with life from there.
Sure.
But else, I think really we will see consolidations.
Yeah.
It'll have to just be, X company buying, the other company which can't get valuation or, can't get the next round.
Yeah.
And you'll have to then pitch yourself on a larger company to move on.
Yeah.
So I've been waiting for some of that consolidation to happen. It's still slow.
It is slow, and we're waiting for those guys who will come and write 100 million checks. It's just not there. I think we are running out of time, but one last question before we wind up. No conversation on private capital is complete without talking about exits. There's a joke that goes, do you know how a private investor enters a room? It's facing the door because he's always looking at the exit.
Totally.
So public markets are doing well. Private companies are going public. All of this is good. But what are the other avenues of exit that you have in mind at the time of investing in these private companies?
Yeah. This is, we write a thesis in our IC notes because we are pushed back a lot on this, and you can't depend a lot. So just going back, right, in Fund 1, we had 11 investments. Only one we said will go to IPO. Of course, it almost seems like a different age. Our markets were also smaller and so on. So going to IPO, a company has become tougher and tougher because the size and scale and the market cap that you need even to be a reasonable mid cap has kind of increased. So if you're a very small company, research coverage nahi milega, and then after that, how do you exit the company anyway? So it's just become, so right now we are a little bit of boom. So a lot of companies are getting listed as well. But I would say as a portfolio allocation at our end, we would be loath to say out of 11 investments, more than 2 go to IPO as the base case of thing. It may happen. That is a upside case, which is great, but as a base case. So we depend a lot now on actually P2P as a very, very, very big zone. That is, we finish our journey and we pass it on to another private equity to continue the journey. So larger private equity equivalent, we have ourselves, we invested in a company called Kokta, which is a vehicle finance company. We bought out IIFL, private equity, which was earlier investor, and we put fresh money into the company. And similarly, others will do from us as we go along. So I think this whole P2P, the other one, and that's developing well. It's about 30% of all exits now, and I think it'll become bigger. I'm saying at the overall level, for us, it's a very large proportion of exits, but for others, it's the industry as a whole, it's about 30% of exits. I think the other one, which is still sporadic, is strategic.
Yes.
It's not yet, it's still about 10-15% of private equity sells to strategic investors. So that's something which I'm hoping will build up and bring that balance to say 25-30 in each of these buckets will be nice. Public markets, this and strategic. But we have to see a lot more of that. But it's also the reason is there are a lot more buyout deals now. So there'll be a lot more strategics later. So I'm hoping that's how it stacks up.
Nithya, thanks a lot. This has been fabulous. Let's give her a big hand for speaking her heart out. Very nice. Thank you. Thanks, everybody. Thank you.
Very interesting session. May I please now call upon Mr. Anil Gilani. He's been the ex-director of the CFA Society India and a very integral part of the society and been a great support to this event as well.